Welcome to another episode of Real Estate Investing Explained. Here's today's question. That reminds me of the Buffett quote where he talks about he'd rather buy a great company at a good price than a good company at a great price.
Exactly. That's the quote I was trying to remember. He'd rather buy a great company at a fair price. So maybe that's 80% or 90%. That's kind of my interpretation of it. He'd rather buy that than buy a poor company at a great price. And he used to always look for poor companies at great prices. He used to call those, he called it like, if you were a smoker, I'm not a smoker, but he said, if you were walking down the street and somebody threw like a cigar and it had like 4 puffs on it and you got it for free, you just picked it up and you got like the last 4 puffs on that cigar. That's like the best return on investment, right? You didn't pay anything and you got 4 puffs. That was kind of like the companies he used to buy. He used to buy these companies that were spiraling down, but he would figure out that they had, a bunch of silos of corn still that he could like liquidate the corn and make a bunch of money. He would look at the assets of the company and figure out that if I liquidated the company, I'd still make money because the price is so low. That would be like, buying some of these really cheap properties in D neighborhoods where it's so cheap, somebody's almost giving you this lot. Like, can't lose on that, right? Well, actually you can because, maybe you can't collect that rent. Maybe you burn out. Maybe things change in the neighborhood and the next door landlord doesn't manage their property well and there's drug dealers like dealing drugs next to you. So I think the equivalent in real estate is people might be familiar with like A properties, B properties, C properties, and D properties. It's hard to make money on A properties. Those are like the best locations and the best towns, and you're making like 2% cap rates or 3% cap rates. And there's some really big money people who might play those games. But I found for us, smaller investors, A properties are kind of tough. But we can buy in B neighborhoods and C neighborhoods. And I define for myself B neighborhoods as the type of places where they are more owners than renters. So you might have like 80% owners, 20% renters in a B neighborhood. And then in a C neighborhood might have like 50-50, like 50% owners, 50% renters, but it's still blue collar. It's a good place. It's safe. When you get into D plus, there's still good people living there, but it's mostly renters. You might have public housing and it's just a different game. And so like, I'm not knocking those or saying nobody should invest there. But for you, if you're learning the business and you're just getting into it, going with a solid C plus, B minus is probably the place to play. And you might not get the huge discount like you would on a C minus, D plus property, but you also be more comfortable being in the business as well.
Yeah, I generally find my sweet spot in that C plus, B minus range, just like you said. And it's tough for new investors. I know when I was getting started, I was very drawn to those D plus, D level markets because you look at the numbers on paper and you just look at the prices of the properties and they're very, very tempting. The numbers look really good, but what you need to take into consideration is the high risk that you're taking. And just like you said, you might not collect your rents or something else might happen and it's just not going to end up being those returns that you're expecting. So you can get high returns there, but it's also super high risk. That's all for this episode of Real Estate Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.